We all know the effects of a market crash. A lot lose their money and may even end up being bankrupt. Businesses close, and this ends with a lot of people losing their jobs. And for us investors, it's a stressful sight to see your investments dropping. That's why these are the times when your self-control would need to be at its highest. For one wrong move you make due to emotion can lead you to lose a lot of money and may even end up disappointed in the end when you see the market already recovering while you get left behind. So for today, I will discuss the things we can do to protect our investments and take advantage of the opportunity being presented to us. Now before we begin, I would appreciate it if you support the channel by clicking the like button. First of all, before we dive into the things we can do, it's good for us to understand what is a market crash. A stock market crash is a rapid and often unanticipated drop in stock prices. It can be a side effect of a major catastrophic event, economic crisis, or the collapse of a long-term speculative bubble. Exaggerated public panic about a stock market crash can also be a major contributor to it, inducing panic selling that depresses prices even further. Now, a drop of 20% or more in the stock market is considered a market crash. This can last up to 11 months and sometimes even take up to 5 years, while a market correction is a drop of only 10 to 20%. This can be seen in the PSEI index, wherein from its previous high in 2019, which is 8,400, dropped below the 4,500 mark. This is a drop of more than 42%. More so if you compare it to the highest point of the PSEI, which is in 2018, when it had a record high of 9,000. That is a whopping 50% drop. Now this has happened a lot of times in 35 years, 1987, 1989, 1997, 2000, and 2008. I won't be diving into detail as to what happened during these times since I already made a video about it. If you want to watch it, there's a link in the description below. With this, knowing that the market crash usually happens, and when it happens, typically the stock market often recovers and even ends up breaking its previous record. But sometimes it takes a while and may end up making a lot of investors impatient. That's why the first thing that you should be doing during times like this, and probably the most important to do, is to control your emotions. No matter how knowledgeable you are about stock market strategies, formulas, charts, etc., when you let emotions control you, then you wouldn't be successful in the long run. A lot of investors do this mistake. Although yes, they do have a strategy, but when stocks take a downturn, they panic, selling their stocks. Likewise, they compromise their strategy when they see one stock's price skyrocketing. They feel they will be left behind, so they buy in at a very high price. Remember, stock prices fluctuate. It isn't a steady uphill. Just like what I've said earlier, in the span of 35 years, the stock market crashed 5 times. Or you can say in our index, a crash happens every 6 to 8 years. So if you can't handle the fluctuations, then the stock market isn't for you, and everything that I will be saying later would be pointless if you can't control your emotions. As Peter Lynch said, you get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. The second thing you should be doing is go shopping. Of course, stocks are cheap during these times. Why wait for the market to recover? This is the best time to buy great companies at a huge discount. Like Warren Buffett said, when it's raining gold, reach for a bucket, not a thimble. Most investors, what they do is, they cover themselves with an umbrella. They stand on the sidelines because they are too afraid that the stocks would go further down, so they just wait until everything else is okay. But when that time does come, stock prices have already recovered, so you miss a great opportunity to bulk up your portfolio with cheap stocks. So why put on an umbrella? Instead of catching the gold ride, you get a bucket and catch whatever you can catch. Philtown, a big fan of Warren Buffett, even exaggerated this. You don't just go out with a bucket, you go get a tub. A lot of wealth has been created in market crashes, so use this opportunity. But of course, there's always a catch. You don't just buy any company. You buy the companies you know, companies you've researched and analyzed. As I've mentioned, great companies that are trading at a discount. You buy companies that you are sure would survive the conflict that is happening. The third thing some investors should be doing, well, this may come as a surprise since I just said that you go shopping. It is to just do nothing. Sometimes, really, Doing nothing will be beneficial for you. If you believe in your investing strategy and your current portfolio of assets, then you can just ride the storm easily. You can just leave it since you know all the companies you've bought will survive in the end. This is a better strategy than panic selling, and sometimes inactivity can prevent you from being emotional in the first place. If you look at the PSEI, if you invested in the peak of 1999 before the crash, even if you did nothing and just leave your investments there, your money would have still grown massively. And there are times when even in a market correction or a market crash, you still can't seem to find good companies you want to invest in. So rather than compromising your strategy, then just wait for the stocks you want to invest in to go on a discount. Charlie Munger emphasizes this: the big money is not in the buying and selling, but in the waiting. Now you still have to weigh everything down. For me, I combine it with what I said earlier. I do nothing when I don't have money to invest with, or there aren't any stocks I want to invest in. And when I do have money and there's a stock I want at a discount, I go shopping for it. The next thing you can do to take advantage of a market crash is to reinvest dividends. Well, I've said this countless of times in my videos, so if you want to watch my video about why I love dividend investing, then there's a link in the description below. Now let's say the market goes sideways for quite some time. Of course, not all of us have enough funds to go shopping all the time, right? You reinvesting dividends can help fund your investment, and the best thing about reinvesting it, the next year, even if the market hasn't yet recovered, the dividends you reinvested will earn more dividends for you. This is literally money working for you, and if you compound that in the long run, dividends will take up a big portion of your overall returns. In fact, in the US index, which is the S&P 500, dividends take up 40% of the overall returns. And you know, in some decades, like in the 1970s, dividends takes up 73% of the overall returns of the market. So just imagine if you didn't reinvest it back. In a sideways market where stock prices don't move for a long time, dividends may be the only returns you may get. The last thing you can do is to cost average. This is connected to going shopping, but sometimes investors just pour in all their money at once. Now no one knows if the market will drop even more, and likewise, no one knows when it will recover or if the price would be stagnant for a long time. If you cost average, buying at different time frames, even if the market drops after you buy, you get to buy again at a lower price. Though sometimes, yes, you may be buying at the very bottom, but still, as mentioned, no one knows if it's the bottom. At least this way you are sure you get the average price during that time, and if you don't have enough cash, assuming the market stays that way for a long time, just buy and buy when you have enough capital. Now this is a good strategy, especially if you're investing in an index fund. But for individual stocks, it's better to combine this with a value investing approach. If you have a computed intrinsic value for the company and you have already set a buy price for it, when that company reaches that certain price, then that's when you buy in. That's when you cost average. And when that company is already beyond your buy price, then find a different company on your watch list that is still undervalued and repeat the same strategy. Now, if you want to learn more about this and how to compute for the intrinsic value and your buy below price, I've made a video of one of the few known formulas on how to compute it. There's a link in the description below. With that, this ends this video for today. So I hope you've learned something, and if you did and still haven't clicked the like button, then I would appreciate it if you do so before leaving. And if you want to learn more about finance and investing, then might as well hit the subscribe button to be notified whenever I post a new video. So thank you and see you in the next video.